Good afternoon, boys and girls. Welcome to the weekly wrap-up for Friday, July 8th, 2022. Hope everybody's had a fantastic week. Been pretty nice here in Colorado. Got a few rainstorms here and there, but it's going to be probably a clear weekend. Unfortunately, it's going to be kind of hot. The people in Denver are all crying because it's going to be up near 100 degrees down there in the down in the mile high city. I live a little further. I'm a little further elevated, so it'll be a little cooler, but I don't have air conditioning, so it'll probably be a little toasty tomorrow. So feel sad for me. So, all right. Well, not a bad week in the markets. It looked like, it was a short week with the 4th being on Monday, but, looking at the charts, not too bad considering all the crap going on in the world. So let's go ahead and dive in, take a look and see how the major indexes across the world did. Dow Jones actually finished down slightly, 0.15% at 31,338. The S&P 500 was down 0.11, closed at 3898. NASDAQ was up 0.12, closed at 11,635. Small caps were basically flat. They finished down 0.08. The VIX receded again today, another 4.87%. It's currently sitting at 2481. That's something I'll pay attention to, folks. When the VIX starts to climb again and gets over 30, that's when the volatility gets high, and that's when things get a little messy. All right. See here in Canada, they were down 0.21. Brazil down 0.44. Mexico was up 0.41. Moving over to Europe, Germany up 1.34%. The UK up 0.1. France up 0.44. The Euro Stoxx up 0.52. Netherlands up 0.42, Spain down 0.27, Italy up 1%, Switzerland up 0.68, Portugal up 0.47, Belgium up 0.45, and Austria up 3.07%. Moving a little further down, looks like the Russian exchanges were mixed. The MOEX was down 0.19, while the RTSI was up 1.09%. Moving on over to Japan, they were up 0.1%, Australia up 0.45%, New Zealand up 0.71%. Heading on down to the Chinese markets, the Shanghai was down 0.25%, the SESE component down 0.61%, China A50 was flat, it finished down 0.04%, DJ Shanghai down 0.35%, and the Hang Seng rounded out things at up 0.38%, and the Taiwan weighted was up 0.89%. So kind of a mixed day across the markets, nothing up, too dramatically. Most things were within 1% up or down, so not too shabby. So, all right, well, let's take a look and see how the indexes did for the week. All right, after a really bad Tuesday, let's take a look and see where things finished up. See, the Dow Jones was up 1.46% for the week. The S&P 500 looks like it was up 2.97% approximately. NASDAQ looks like it was up 6.2%. That looks like it might be the big winner for the week. The Dow Utilities looked like they were down about 2.64%. And the Dow Transports, to round things out, looks like they were up about 1.55%. Again, these are not exact numbers. I'm just giving you some approximates. We'll get the final data on Monday at during the weekly update. So let's go ahead and zoom out a little bit and take a look and see how the major indexes are doing right now. As far as their trends, you can see here on the Dow Jones, starting at the beginning of the year, this resistance line has really been the when the market's been rallying, it's kind of bounced off it. We did break through, like I've mentioned on a couple of occasions here, late March, and then again in late May. But these rallies have run out of steam every time, and we'll see what happens with this rally here. So, what I'm looking for is something to break through and actually get some distance between this. So, but until that happens, I don't have a lot of hope for the uptrends currently. So, looking at the S&P 500, again, kind of a similar chart. Again, you reach kind of we get a bit of a uptrend for a while and then loses steam, and reminds me a lot of 2008 and 9, where even when we had 4 to 6 weeks of uptrends at a time, it still didn't, it did sustain it. And it wasn't until the market bottomed out and capitulated that we really saw any any big changes. So, all right, well, let's go ahead and run through the economic data that came out this week. Starting out with initial jobless claims, they came in at 235,000. Forecast was 230, so just slightly above forecast. And looking back over the last few months, we've been over 200,000, going back to, the first week below 200,000 was April 28th. Since then, we've been in that 200 to 230-ish range. So again, it's not too bad. Companies have basically telegraphed that they're planning on doing some layoffs. So it's not surprising that it's climbing up a little bit, but still, well within what we would consider normal. Continuing jobless claims came in at 1.375 million. The forecast was 1.327. Again, looking back here historically, we've been below 1.4 million, again, since April 28th, and been in that 1.3 range for a number of months now. So again, jobs are a lagging indicator that, you'll actually see companies start to downsize and, or go out of business altogether well before you start to see the jobless claims start to really get out of control. All right. U.S. factory orders came out this week. Month over month was up 1.6%. The forecast was only 0.5%. So beat the forecast this month by quite a bit. The job openings and labor turnover survey job openings, we currently have 11.254 million jobs available. The forecast was 11 million, so a little bit better than forecast. And as you can see, we peaked back here in, May, and at 11.855 million jobs. That looks like the peak here in the recent, or I guess the last 5 years. So there's plenty of work out there. In most cases, it's a skills gap, or people just don't want to do the work that's out there. The U.S. Servicing Purchasers Managers Index came in at a 52.7. The forecast was a 51.6, so a good number there. U.S. Nonfarm Payrolls increased by 372,000. The forecast was only 268, so quite a bit above forecast. Looking back here, it has been trending down for the last few months. The high point was 678,000 back on the March report, and we've had a few months in the 400,000s, and now we've got 2 consecutive months in the high 300,000s. Again, a lot of that has to do with we're kind of at full employment at the moment. So the U.S. unemployment rate is currently sitting at 3.6%, right on forecast. We've been at that 3.6 number for 4 months now. So again, good news. It's not all, I feel like I'm always pointing out the bad news out there in the world, but this is certainly good news. The U.S. labor participation rate is currently sitting at 62.2. Previous was 62.3. So it did pull back, 10 basis points. But again, you can see, I know I've talked about this a lot in recent meetings. Prior to the whole corona, we were at around a 63.5. Took a huge drop back in those first few months down to 60%, and now we're back up to 62.2. So, there's probably a lot of factors involved there. People who are near retirement age, the boomer generation, they're just like, screw it, I'm done. I'm going to take my cookies and go home and ride this out until things either get better, or like I said earlier, there's potentially some skills gaps out there in the marketplace. All right, let's go ahead and read through today's market recap. S&P 500 cuts losses to inch higher following stronger jobs data. The S&P 500 turned positive Friday after cutting losses, even as a strong jobs report reaffirmed investor bets for the Federal Reserve to persist with plans to front-load rate hikes to slow inflation. Again, it could just be me, but I always get the feeling that the people writing these articles are really in favor of slashing rates and keeping rates at or near zero. I mean, yeah, it's kind of like, it makes you feel good, but at the same time, you're hurting yourself in the long run down the road. So the U.S. economy added 327,000 new jobs in June, well above consensus for 268 new jobs in June, while the unemployment rate was unchanged at 3.6%. Average hourly earnings slowed to 0.4% from 0.3% a month earlier. The participation rate, the number of people entering the job market, fell 0.1%. This suggests the supply of labor will continue to be constrained, and the wage pressure that has been building up doesn't look like it's going to abate anytime soon. Dean Smith, chief strategist and portfolio manager at Folio Beyond, said in an interview with Investing.com on Friday. Probably not the same Dean Smith who was the leader of the North Carolina Tar Heels for a number of decades. I think he's gone or passed away in recent years. The strong report, Morgan Stanley said, offered support for a 75 basis point hike at the July FOMC meeting. End quote. Treasury yields jumped following the report, with the 10-year rising back above 3%. Growth sectors of the market, like consumer discretionary, shrugged off the rise in yields. Tesla pushed consumer stocks higher with more than 3% gain after the electric vehicle maker sold a record number of EVs in China in the second quarter. Housing stocks, including Pulte Group, D.R. Horton, and Lennar Corporation, which have been battered by worries about demand as mortgage rates jump, were also among the top gainers. Levi Strauss was up 2% after the jeans maker reported quarterly results that topped Wall Street estimates. Quote, our second quarter results demonstrate the power of our strategy, which continues to support strong revenue growth and margin expansion, end quote, said Chip Bergh, president and chief executive officer of Levi Strauss. Big tech traded mixed, with Apple and Alphabet slightly higher, while Meta Platforms and Microsoft traded in the red. Twitter, meanwhile, was also a drag on tech following a report that Elon Musk's $44 billion take private deal is in, quote, serious jeopardy as the billionaire remains wary about fake accounts on the social media platform. Yeah, I think in the end, he's going to wind up making the purchase, but he's going to get it for a much better price than the $44 billion that was originally offered. Again, I think he'll probably prorate it based upon the number of actual users, not bots and whatever else they've got running in their system. So Musk's reluctance to move forward with the deal has many speculating that the billionaire is angling for a price cut deal to acquire the company. Hey, it's like we're clairvoyant here. And I read this earlier. So, quote, the Twitter soap opera is clearly coming to some sort of a finale over the coming months as Musk makes it the decision to stay with lower price or go, Wedbush said, adding that the odds of the deal proceeding at the $54.20 share price is about 5%. In other news, GameStop fell 5% after the video game retailer said it has fired its chief financial officer, Mike Recupero, and is laying off staff across the company as it looks to execute a turnaround plan. Boy, GameStop has been all over the place the last couple of years. I mean, I know they were a meme stop that the folks on Wall Street Bets on Reddit were big on as far as, lots of options plays. So, you could have made some money on that. You could have lost some money. It's been very volatile over the last couple of years. All right, moving on to an article on jobs. U.S. job earnings growth stayed strong in June, cementing rate hike outlook. The U.S. economy continued to create jobs at an impressive clip in June, making it easier for the Federal Reserve to carry on with a series of aggressive rate raises in interest rates. Non-farm employment rose by 327,000 through the middle of last month, only a marginal slowdown from a revised 384 in May, and well above analyst forecasts for a gain of 268,000. The department noted particularly strong gains in professional and business services, leisure and hospitality, and healthcare. Average hourly earnings also stayed strong, growing 0.3% on the month and 5.1% on the year, a little ahead of expectations. The numbers come less than a day after two senior Federal Reserve officials, Governor Chris Waller and St. Louis Fed President James Bullard, both expressed a preference for raising the target range for Fed funds by another 75 basis points this month. Quote, this job report does nothing to change the Fed track, said Robert Perley, head of global policy research at Piper Sandler and a former Fed economist. Quote, despite a clear slowdown in job creation and wage growth recently, the labor market remains in good shape for now. This gives the Fed cover to continue to focus extensively on bringing down inflation and remain hawkish, end quote. Quote, the level of non-farm payrolls has been completely and utterly inconsistent with anything that we could possibly be called a recession, as indeed has the length of hours worked, end quote, UBS Global Wealth Management's chief economist Paul Donovan has said in a morning note ahead of the release. Average weekly hours worked stayed at 34.5 in June, while that number has eased from a decade high over the last year, it is still very much in line with historical averages. The unemployment rate, meanwhile, remained at 3.6% of the workforce for the fourth month in a row. The numbers mean that the private sector has now recovered all of the net job losses seen at the start of the pandemic. By contrast, government employment is still some 664,000 lower than in February of 2020, the Labor Department said. Well, and that's a good start. We need less people on the public dole. I mean, paying welfare for jobs that we really don't need probably is a good thing in the end. So, all right, so that's definitely some good news. All right, last article I got for today. It's hopefully making this a quick one. Debunking the key misconceptions about oil and gas prices. I know you probably have seen where the president put out some, well, probably someone on his staff wrote it up, making a pleading to the oil companies to slash your prices. We're in the middle of a war. Y'all need to, take it in the shorts so that the American people can have cheaper fuel and everything else. Well, let's read through this and see how much of that is true. There are some major misconceptions when it comes to oil and gas prices. Many politicians are quick to blame oil companies, but the market is much more complicated than that. While oil companies have seen windfall profits thanks to the increase in oil prices, they are not the ones that are driving prices higher. It is true that oil companies benefit from the actions that increase the price of oil. Over the past couple of years, OPEC has taken actions that have increased the price of oil. In April of 2020, OPEC Plus, a group of 23 oil-producing countries, enacted a huge supply cut because of the drop in global oil demand associated with the COVID-19 pandemic. In fact, oil prices even turned negative at one point, and U.S. oil producers saw their share prices plunge. President Trump asked Saudi Arabia and Russia to intervene. At the time, he tweeted, quote, "Just spoke to my friend MBS, the Crown Prince of Saudi Arabia, who spoke with President Putin of Russia, and I expect and hope that they will be cutting back approximately 10 million barrels and maybe substantially more, which, if it happens, will be great for the oil and gas industry." Moments later, he tweeted, quote, "Could be as high as 15 million barrels. Good, great, news for everybody," end quote. Those cuts did happen, and that helped shore up oil prices in the months to follow. In fact, between April 2020 and January 2021, Trump's last 9 months in office, the average monthly price of WTI rose from $16.55 to $52 even, an increase of 214%. Oil prices would continue to increase throughout 2021 as demand returned to normal. Then in February of 2022, Russia invaded Ukraine. The U.S. and some other countries made the decision to stop importing Russian oil. Oil prices soared, but that, quote, oil was primarily in the form of products like diesel and gasoline, and it supplied 7% of U.S. imports in 2021. This caused a significant disruption with U.S. refiners, and product prices soared along with refinery margins. Oil producers benefited from the rise in oil prices following Russia's invasion, and refiners benefited from the rise in product prices. ExxonMobil owns both oil production and refinery operations, and they benefited from these price rises. As perfectly legitimate to discuss how ExxonMobil benefited from OPEC production cuts and Russia's invasion of Ukraine, it is in fact the U.S. energy industry that has benefited, and that is at the expense of U.S. consumers. I understand why people are angry about this, but their anger is misdirected. In 2020, ExxonMobil had to sell oil for less than it cost to produce it. They are at the mercy of the markets, which is why they lost $22.4 billion in 2020. Think about it. Do you think ExxonMobil was just being generous in 2020 and decided to sell oil for under $20 a barrel? And in 2022, they got really greedy and decided to sell it for over $100 a barrel. No, it's because that's the way oil is sold. The reason ExxonMobil can influence oil prices is that they don't produce enough oil to significantly impact the global oil supply picture. OPEC, which with 35% of the world's 2021 oil production, can substantially impact that picture. Add in the OPEC Plus coalition, which Russia is part of, and it's close to half of global oil production. ExxonMobil doesn't even produce 3% of the world's oil. If they restrain production in order to try to influence pricing, it really costs them money. So you can be angry at ExxonMobil for profiting at your expense, but just understanding that it's not because they suddenly decided to gouge you. They have no control over this, which is pretty obvious when you look at their quarterly financial reports over the past decade. So again, yes, the oil companies took a bath 2 years ago when oil was trading in the red, and today they're getting much larger or much wider margins on their production today. So it all works out in the end. But again, if we hadn't inflated the money supply by 40%, I imagine oil wouldn't be nearly as expensive as it is. Yes, you would have seen a price spike with or a price increase over last year because the oil companies were going back online and expanding their pumping out of the ground and drilling and all that sort of thing. And then you mix in the whole Russia-Ukraine fiasco a couple of months ago. Yeah, you might have seen a short-term price increase over that time, but it would have stabilized. The biggest problem is, printing $5 to $6 trillion over a very, very, very short window has really caused what's going on right now, at least in my humble opinion. So, all right. Well, that's everything I had for today. Hope everyone has a terrifical weekend and go and watch a lot of Astros baseball like I'm going to. And let's see, they play tonight at, if you're in 7 o'clock Mountain, 8 o'clock Central, for most of my clients are in the Central time zone. So they're playing out in Oakland. So let's cheer them on. Love my Stros. And if anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information's there. To book a meeting, drop me a phone call, send me an email, whatever you'd like to do. I'm always here for you. So hope everyone has a good weekend, and I'll talk to you guys on Monday. Bye-bye.